So thank you all for joining in for ITMIC's first fifth year series. We usually have industry experts and people who are exemplar in the field joining us to shed a few expert insights on certain topics. And today's topic is how do VCs evaluate startups for investments. And we have Sarita Raichura, principal at Blume Ventures, who joined in for this session. Sarita also heads the program, which is Blume's new initiative called the Blume's Founders Fund. Prior to this, she was a regional head at the Indian Angel Network. Without further delay, over to you, Sarita, to take this forward.
Hey, thanks, Kalyani. Thanks for the opportunity, and thank you all for joining in. I hope this session will be useful. I have prepared it more with the idea that you would like to understand how VCs evaluate and even understand what goes on behind, what is the calculation, what do we look for. But at any point, if you think it's you want a little more basic stuff which I have not covered, I'll be happy to cover it. So just maybe to get a sense, Kalyani, I'm not sure, but are most of you all in the very early stage? I'm presuming you all are in the very early stage, either at a pre-seed or a seed stage. And most of you,
so we sort of have a mixed crowd here. We have few of our startups as well as it's open to external. So it's a mixed crowd.
Okay, great. Give me one sec. Let me just share my screen. Yeah, so before we get started, like Kalyani just mentioned, I've been in the angel investment and VC space for 5 years now. Prior to that, I was with the corporate world, but I was always intrigued by entrepreneurship and investments and how it worked. So would love to take you all through it. First of all, congratulations. All of you all are founders, and entrepreneurship in itself is a great journey. Most of you are probably right at the beginning of it. And the whole idea of this session is to just take you all through what goes on in a VC's mind and how do we evaluate startups, right? Feel free to stop me at any point when you have any questions, and we can pause. It's going to be more interactive. I don't want it to be like a Gyan session. I want it to be more interactive, so feel free to stop me at any time, right? So what will we cover today? We'll cover how VCs work. Before I take you through how we evaluate, you should understand what happens in a VC and how do we work. Even I didn't know, even though I was in investments earlier, I didn't know exactly how VCs work. So it'll be good for you to understand what are the VC strategy. Then how do VCs evaluate an investment, stages of a startup, and typically what kind of valuation you can expect. And then we'll close with the life of a founder. So it started off with, as I was thinking, firstly, I should thank my colleague Arpit. He had created this presentation, and I just borrowed a lot of slides from him. I just added a few things which I thought would help. So I got a call 2 days back from a friend who's just started off in a farm, and he's what do you say, keeping a lot of livestock, growing them, rearing livestock, and he wants to sell them, and he wanted to raise money for that. So he called me saying, hey, can I raise some funds and stuff? That's when this came to me. The question is, firstly, you need to think about what kind of funding you require, right? It's not always wise to take VC money. So I will take you all through. If you look at the slide, you should also read this book. I have this book here with me, which is like a startup Bible, Secrets of Sandhill Road. I think all of you should read it because it kind of gives you a great insight on the VC world and how things are evaluated, the history, how it all started. And I think it's a good one for all of you to, if you want to understand how this thing works. And it's a good one for each of you to read through. So when I look at, first and foremost, when you start off, evaluate what kind of startup is yours and what kind of financing you need, right? You have debt financing. Firstly, you bootstrap and you figure out you have some small friends and family around, and then you're profitable. You don't need cash. But if you need cash, What should you go for? Should you go for debt or should you go for equity? So here clearly, when you go for debts, you have banks, you have alternate lending platforms. It has its own positive negatives. And if you go for equity, you have angels, you have VCs, you have individuals who micro VC funds, and that has its own advantages, disadvantages. So starting with debt, when do you go in for debt? When you think that you have a business that is very likely to generate positive cash flow very quickly, and you'll be able to pay back interest and the ultimate principal within the 3 to 5 years, that's a good time to go and raise debt. Now, why would you raise debt? Why not equity? Equity is easier, you feel, right? No, you raise debt because you retain complete control of the business. You're not answerable to anybody. You just have to keep paying the bank the interest or keep paying the financial institution, and you're set. Now, in the case of my friend who's doing the livestock rearing, he said, I just need 15, 20 lakhs and then, I'll buy this, I'll rear it, and I should be profitable in 3 to 6 months. In that case, you really don't need to go in for equity funding. You just go in for debt funding when you know that you're going to be profitable very soon. You have a customer line in place, you know that the business is going to generate cash very quickly. When do you go in for equity financing? When you know that your business will not be generating cash in the near term, when it's a very risky business and banks will not lend any money, and if you have long periods where you don't have liquidity, right? So I'll give you some examples here. All the cash that you need will be required for expenses. So any business, like if you see any of your cabs, Zomato, Swiggy, they've consumed huge amount of money, right? Flipkart, for example, they knew that they won't be profitable at a very early stage, right? So they clearly needed to go in for equity, because what happens in equity is you give up some ownership for the funds, and there is no liability from your side. Of course, a lot of times my friend who's borrowed, who's raised from VCs, he says once you raise VC funds, you should be ready to run on the treadmill. And run on the treadmill meaning, you have to be at it. Give up like 8-10 years of your life. You should be willing to run and not take it easy. Whereas in this traditional form of business, you take debt. As long as your business is profitable, there's no pressure. But from a VC angle, when you take money, you have to be aware that you're going to give up ownership in your company. Likely those partners or stakeholders will own board seats in your companies. And therefore, you will have to, they don't want your short-term gains. They're not looking for short-term money. They're looking for long-term huge exits. And I'll take you through why you can't say, oh, VCs, how can they expect this? But you have to understand the VC model to understand why VCs expect and will invest in a business only if it's a very long-term huge exit that they see. Any questions here? Okay. How a VC? Yeah.
Yeah. So the VCs are not interested in short-term gains.
If they want really good exits. So if you tell them in 1 or 2 years you'll get 2x, 3x, no, they're not interested. VCs want to see a 50x, 100x return, and they are willing to wait for it. So they know that to get a huge exit, you will need time. So if you tell me, my business will give you 2x of your money in 1 year, a VC doesn't care. It doesn't work for that model. Okay. How does a VC work? Now, who are the players in this VC world, right? You take a typical VC, you have something called LPs. Who are the LPs? They're limited partners. Who are limited partners? Basically, HNIs, family offices, corporates, government bodies, pension funds. All of them basically are the limited partners. Mean they have excess funds and they're willing to put some percentage of these funds in a very high risk category. High risk, therefore high return. So they're expecting high risk, high return. So they take these funds and they give it to what we call the VC fund. And the VC fund is managed by who? GP. GP is general partners. So basically every fund will typically have 1 to 3 to 5 partners depending on the size of the fund. In our case at Blume, we have 3 partners, Karthik Reddy, Sanjay Nath and Ashish Fafadia. And as people grow, in the org, and as the fund becomes larger, more people are, you need a little more partners to manage the portfolio. So GPs are liable to return the funds to the LPs, right? To the limited partners. So they take money, they invest in startups. The job of the GP or general partner is to invest in startups and eventually realize some huge returns, which they can return to LPs. Why should the GPs do it? It's a long journey. It's 8 to 10 years. What is in it for the GPs, right? So we'll go through that. VCs get something called the carry. So I'll take you all through how the carry works. Any questions here? Okay. Yeah, so like I said, fundraise. First, the general partners at the VC firm raises money from limited partners. So that's when you say they first close, they've closed out of 100 million round, they've closed 20 million. Then they source startups. They discover interesting startups to invest in. Then they invest in. They do due diligence in the source startup, and then they invest this money in. Then they add value. So this is called portfolio management. So they help the portfolio. I'll tell you how we help the portfolio, right? We have a platform team. How do we help our portfolio companies? We help them with what does a startup need? They need legal finance help. So we have an arm for that. They need help with hiring the first few people on their team, hiring constantly as the startup venture grows. So we help with hiring. Then we help with community building. So we help build. Then we help with mentorship. So we find industry leaders, leverage our LPs and people in our industry who will help mentor. So lots of value add, and they'll also compare and give them comparisons, benchmarks, etc., which will help the portfolio company. And eventually the goal is everybody wants to make money. So the goal is to make money, and there's only 2 ways to exit an investment. Either M&A, the company gets acquired, or it goes IPO. So basically you go public. Very rarely you will see where a founder will say, hey, I don't want to get acquired. Please buy, I will buy back your stake. That doesn't typically happen. Any questions here? Okay. Now, let me take you through this fund example, just so you'll understand. I will skip the cash flow. I think it's not necessary, but let me take you through this typical $100 million fund. So when you hear, say Blume has a $100 million fund, how does it work, right? So the structure is called 2x20, right? 2x20 structure and a 10-year horizon. What does this mean? 2x20 means of the $100 million, 2% of the funds every year goes as management fees. So how do I get paid, right? My GPs or partners, they raise the funds. They've got 100 million commitments. Then how do they run? Because they're investing in startups, yes, but you have to pay salaries to the team. You have to rent an office. How do they do that, right? So they get 2% of the fund every year as management fees. So in this case of a $100 million fund for 10 years, every year you take 2% aside, which is $2 million. And therefore for 10 years, $20 million. So $20 million over 10 years will be your management fees just to manage the funds. Okay. Any questions here? No. Okay. So when you remove that 20 million, you have an investable corpus of 80 million, which means now out of the 100 million, we've kept 20 million aside as fees to manage. And then we have the $80 million to invest in startups. Now, when we want to invest, we say we can't invest all the 80 million. So suppose I say we write 1.5 million or 1 million checks. We're writing $1 million checks, which is 7 crores checks. Can I write 80 checks because I have $80 million? No. What a VC does typically is keeps a reserve ratio. So if for every 1 check that they write, they will keep 2 rounds of funds or 3 rounds of funds for that specific investment. So basically to back the winners. Only some companies will faint, but if you really want to make money, you have to back your winners. So they keep something called the reserve ratio. So for every 1 investment, they keep a 3x of that as reserve ratio. So for example, if they're investing 1 million, they keep aside $3 million. So total out of $4 million, you have to keep aside for each investment. Therefore, if I have $80 million, I can write only 20 checks. You get that? Okay. So typically, yeah, I think this fund cash flow is too complex. I would skip that. Maybe later, if somebody's interested, I can take them through it. But essentially, that's basically that's the 220 rule. Now, yeah, 220 rule may, like I said, 2% is the management fee. 20% is structure. What does 20% mean? Can anyone tell me? Does anyone know here? What does the 20% mean? Okay, the 20% is essentially when we return the funds. So you're liable, right? It's limited partners' money. It's not our money. So the GPs at the end of the 10 years have to give back, have to, at every point when they have an exit, they give back the LPs the money. Whatever money, once they return the $100 million, then they can make, then whatever excess they make out of the 100 million, they get to keep 20% of that. Now, for example, we had a $100 million fund. We have grown it to $300 million. We've got $300 million worth of exit. Therefore, our partners have made $200 million profit, and $200 million profit is 20%. So $40 million will be the carry. It's called the carry. This is what VCs work for. VCs don't work for the investment fees. They don't work for, because that's nothing. They mostly come from very qualified backgrounds where they can make the money. They work and they give up, they give 10 years of commitment for something called that the carry, right? Now, understanding VC asset class. Basically, it's the riskiest asset class in any LP's portfolio. LP is your limited partner or your high HNI or what you call them. Typically, they have to invest minimum 1 crore. 1 crore is the minimum according to the Indian regulations to invest in a VC fund, right? And it's the riskiest class. Therefore, they expect very high returns for this. If you see an LP's typical portfolio, they'll put it, this is how they allocate their capital. And therefore, they feel that very small amount, if you see here, 5% of their portfolio. If you are worth 100 crores, you will not put more than 5 crores into a VC fund. Yeah. Now, this is how the VCs work. Let me go back here. Any guesses on what percentage of startups that a VC funds are successful, meaning they give them at least 5 to 10x return? Any guesses? I should have had some chocolates or something here.
About 2%.
5%.
2%.
Yeah, like probably what we call the dragon, but yeah, between 2 to 10%, it's like 5%. So if you see here on this chart, 5% of the startups that are VC funds, out of that 20 startups that I'm funding, one startup will give me the 60% of my 100 million back. So that one startup will give me 60 to 80 to 100 million back. You're getting it, right? Basically, so the VC has to look at every startup with the angle that, so now here, look at the deals done. This is actual data from US venture investments. These are the deals done, right? If you see 50% of the deals gave almost 0% return. Can you see that? So 50% of deals here, gray. And here, if you look at this gray, it's less than 2 or 3% return. And if you see top 6%, top 6% of the deals gave them 60% return, right? So therefore, VCs go with, they know that there are going to be failures. There are going to be some of them who will give 1 to 2x return. Some will give 2 to 5x return, some 5 to 10x return. But that's not exciting. The VC is looking for greater than 10x return. Only then it makes sense. So if I put in 1 million, I'm expecting at least as a minimum to get 10 million back of that investment, right? So if you tell me, I would love to work, and I'll give you back 2x. Does it even make sense for me? If I give you 1 million and you give me 2 million back, how am I going to return my 100 million fund, right? And 100 million is basic. I have to make 300 million. So if every startup tells me, I will give you, you're giving me 1 million, I'll give you 2 million or 3 million back, then it's not going to work, because we know that 50% of them are going to fail, right? So let's just go through the startup curve. Typically before startup, there's excitement, there's enthusiasm, then reality sets in, then they experimenting with the pivot, somewhere.
Sarita?
Yeah.
So, sorry to interrupt, but there was a question on our chat from one of our participants. Pragyan has asked, is the 2/20 rule fixed for all VC irrespective of the funds?
Yeah, typically, yes. Sometimes if the VCs are this is a broad rule, thumb rule for all. If the VC is extremely successful, I have heard some of them who are really, there's a line, people wait for years to get into, to become LPs in certain kind of funds, which have performed, which have shown 5x, 10x performance over and over. Then their LPs typically charge 3 and 30 also. So, but yeah, I would say 90% of funds will have the 220 rule. Maybe 10% will have a 330 kind of arrangement with the LPs. Yeah.
Is there a regulatory requirement, statutory requirement?
No, I don't think there is any, I think I'm not sure about statutory requirement. This is typically 2 to 20 works. I'm not sure if for 3 to 330 they need to take any specific permissions and stuff. But this, as a norm, 220 is the rule. Yeah. Let me just. Yeah, so typically when we'll go through the different stages of funding, but essentially, reality sets in, you start working when product market fit happens. And when you're ready to scale, that's when a VC will come in. This is somewhere, at least you should have a product market fit. A lot of companies can be pre-revenue, that's fine. Some VCs insist on seeing some traction with customers, some pilots, etc. But having said that, there's no hard rule. If you're a second time founder, you walk in, you raise 3 million, right? Because why? Because you've proven, you've already shown that you have cracked, you've returned money, you know how things work. Second time founders definitely can come in even at a idea stage. But most other founders, first time founders, they should, VCs will entertain them only when they have a product market fit. Yeah. Yeah, so product market fit, let's just quickly go through this. When someone arrives at a paying customer, it's worth something. So what are you worth at, right? Typically, idea is nothing. Ideas are dime a dozen. Unless you're a second time founder, your idea doesn't mean much. If there's an IP involved, yes, then you have some value there. If you bring in a paying customer, that's a good sign. So these are things we look for. So you can write them down or you can note them down, but these are things that we look for. Do you have an IP? Great, positive, +1. If you have a paying customer, again, +1. Do you have a minimum viable product? Basically something which is not just a concept, but the product establishes a concept. You have, without frills, doesn't have to be like, all frills attached. It can be basic, but it's working. If it's not working, you go back to step 1 again and start. And then you know how to find these customers, build the product and sell it to them profitably. When you're at that stage, this is when you've achieved product market fit. We've talked to founders who have said it takes time. It's not that easy to get the product market fit. People go through different iterations, they pivot, they figure, because at that point you don't need to be selling. If you are going aggressively and selling, means your product market, you haven't achieved product market fit. So value of business increases as the risk comes down, and the risk comes down when you have a product market fit and customers are automatically coming to you, right?
I have a quick question there. It's kind of a catch-22. So, there could be cases where product market fit is almost there. You need a VC support to get to the market fit. How do you evaluate that? Second is, if a startup does achieve no contactless product market fit, why do they need the VC?
Yeah. So one is, if you are not there yet, typically what we advise is at a very early stage, when you're first starting off, the best way is to take some friends and family around. So what we say is, when you're at that idea stage, and obviously you don't have money, right? But you can say, borrow from friends, family, typically on a convertible note, the small, take 50 lakhs, for example, 2020, from people colleagues, friends, family. And with that money, you try at least come up with an MVP. Post that, when you have an MVP and you have things going for you, then you can raise angel money. Angel money comes with much higher risk. They are willing to take much higher risk. And therefore, angel money will come in. Say, typically, we'll go through the raises here. So friends and family is typically 50 lakhs. Angel money is typically 3 to 5 crores, not more than 2 to 3 crores, actually, not even 3 to 5 crores, 2 to 3 crores. And then with that money, you hit product market fit. And when you hit that product market fit, then you come to the VC where you're saying, hey, look at this, I already have some good stuff going. In some businesses, if you can hit profitability, great. But in a lot of businesses, you can't, right? When they're ad businesses, I'll give you examples of apps and stuff, social media, those short form video apps, gaming apps, a lot of these, while they can make money, the money is not enough to sustain, because they are building for the longer term, they're building a product. So you need VC money for that. Even if you're profitable at an early stage. In fact, I'll give you an example of one founder. He started this what was it called? Book My Train. I think they got funded by Google, eventually got acquired. Got funded by Google. He was at 10 million users. And he said, what should I do? Should I monetize, or should I keep getting numbers? Either I can stop growing and just focus on monetizing. So you have limited money, what do you do with it? So that's kind of a different conversation. But essentially, if you want to continue growing, unless you're one of these hardware businesses or something which is profitable, then in that case, you go for debt funding. You don't go for equity funding. When you want to continuously grow, then you take VC money, because you're not going to be able to sustain, right? Does that answer your question?
Yeah, it does. Thanks.
Thanks. So risk versus reward. So this is what, as at an early stage, startups have a higher death rate, what we call. So even funded companies, about 30 to 40% are gone in the initial 2 to 3 years itself. Again, riskiest asset class, no return is a reasonable scenario. So 75% of VC funds may not even return principal. It's so bad. So they have to be really, really careful. Otherwise, you may not even be able to return that 100 million that you first raise. Entrepreneurs have to tread carefully between high growth and death, whether they want to. High burn is a big problem, especially during COVID time. We saw that all our startups had to cut their burn by like 50-60%, because otherwise they wouldn't have survived. Cash is king. Sometimes we had to exit a startup of ours. It was a gaming startup in our initial fund, but essentially because they just ran out of runway. There was no cash in and how much can you keep funding them, right? Because you don't know how many times will you give them a chance eventually if they don't have enough cash. So while you invest in growth, you have to be very, very, very cognizant of your cash flow, right? Another aspect of startup funding is size of round and stage of funding. Each round has to comfortably take it over the next logical milestone to raise. So you have to have certain milestones when you are ready to raise the next round. I'll take you all through it in the next. In worst case, bridge rounds do happen. Most VCs will try to save their startup with a bridge round or help them to attain certain milestones which they couldn't with the given funds. So bridge rounds are also common. I think somebody is not on mute. Okay, give me 1 second. So startup valuation, right? Initial stages. Give me 1 sec. Sorry. So concept of valuation remains the same, sum total of future positive cash flows. Now, in some businesses, it's not always easy to evaluate. It's not easy to predict cash flows, future cash flows. And in some cases, like for example, in an app-based taxi service, 100% of the taxis in the past were hailed. There was no taxi base, so you had no benchmarks. So valuation is more of an outcome of demand supply, meaning how interesting is your concept and how many people are willing to buy it. So typically in the early stage valuation, there's no like thumb rule. If you have startups similar in that space, you can look at some comparisons, but otherwise it's very hard. It's more of a science. It's more of an art than a science. Still, typically, I will share some broad typical valuation post product market fit is $10 million. If you at a round size at $3 million is 3 to 5. So we'll go through. I have a whole slide on startup valuations, and we'll go through that. But typically, this sentence is important. First, decide if you want to play, then decide on the price. For example, yesterday we were evaluating a startup. It's in the robotics space. We love the startup. Their expectation of valuation is much higher. Ours is, we don't believe the valuation is that what they are expecting. But are we first going to worry about valuation, or first we're going to make the decision, do we want to play? So first we'll do our entire diligence, evaluate, and we say, yes, we find the space very exciting. We really want to invest. Now let's discuss the valuation. So valuation is not the first thing. Like if you do secondary market investments, you know what the price is and you buy it. In this case, you don't know the price. Price is negotiable. You first decide whether you want to invest or not. Then you discuss the price. Right? So yeah.
Sarita, before you proceed, there was a question on the chat from Rishabh, who's asked about an edtech startup. He's asked, how do they show the MVP for an edtech startup?
Yeah, so I think at an edtech startup, we have a couple of edtech startups in our portfolio. An Academy is one of them, Class Plus is another, and we've exited Mastery. So in the edtech, if it's an app or it's a venture, what you need to show is that without much effort, if it's an app, you're seeing downloads every day, you're seeing increase in downloads, so you can show numbers increase. If it's not an app, but it's like a website or it's a service, then you need to show that without much effort, you're able to sell and somebody's willing to pay for it. That's also an option. So when you can constantly show that like a growth month over month over month, for example, Mastery could show like just people were even willing to pay at a very early stage. Initially, you give free. If you're giving free, you should continuously see growth. We have a video app startup, and you can just see the growth in numbers. So as long as you show some traction, even if you're making no revenue, that's fine, right? I have some numbers which I'll show you, typically what we expect, and hopefully that will help as well. So how do VCs evaluate an investment? 5 things. Okay, before I share it, let's see. You all tell me which are these 5 things that VCs look for. I wish I had some candy or chocolate or something for the right answers. Maybe Kalyani will do the needful. But yeah, give me 5 important factors that VCs look at.
Growth.
Growth. Okay. Yeah, growth meaning how fast they can grow, right? Good one. Sorry.
Founders team credentials.
Yes. I think number 1, the most important is the founders. Who are the founders? What is their background? What makes them the right people to start off this specific venture, right? Anything else? So I've got growth, I've got founder. 3 more things.
Market size.
Market size, correct. Very important. You may be the best founder. You may be solving, you may be seeing some great growth, but if we don't see a market which is large enough for you to service, if you're servicing a very niche problem. For example, if you're going after only, I'll just give you an example. For example, you're going after only pancreatic cancer patients. How large is your market, right? So market size has to be very important. Even if you're the best founder with the best business idea, it will not be funded if the market size is not large enough, right?
Long-term vision, ma'am.
Long-term vision, yes, not really. I mean, yeah, it's important, but it won't be among the top 5 criterias that we look at. It will be part of the criterias we look at, but it's not among those 5 which are make or break. So let's go through. I think I've got some good answers. And
profitability, I think.
Sorry?
Profitability.
No, profitability. VC funds don't look at profitability. Let me take you through this. Right? Number 1, founders, right? It need not be only education. It can be education, experience, chemistry between founders, how the founders interacting with each other, if there are 2 co-founders, ability to attract talent. If you notice how many flipsters or flipkartiers or flipsters, people who were first hired at Flipkart, have gone on and raised funds and created unicorns, right? That shows the ability of Sachin and Binny Bansal to have attracted fabulous talent. Similarly, PayPal in the US, right? PayPal has created a mafia of unicorns. People have gone out of PayPal and created. So interestingly, YC once was telling me that the only criteria is to see who are your first 5 employees. Based on your first 5 employees, they'll decide whether they want to fund you or not, because that shows the ability of the founder to convince people of his idea and buy into his idea, giving up their jobs, their high paying jobs, and coming and joining a founder. That's a big sign. In fact, I was often told that you would rather fund a type A founder with a type B idea versus a type B founder with a type A idea. Do you get it? Basically saying the founder is key. Does he have fire in the belly? Will he run that treadmill for the next 10 years, right? Does he have that in him? Sometimes you call them jugadu. Sometimes you call them, they have that. So that is very important. Most VCs will behaviorally and look at all kinds of ways to judge whether this person will run the treadmill, right? Market size, somebody mentioned here, that's right. Market size is extremely important. How large is the market? And is the problem worth solving, right? And is it scalable? So scaling is extremely important. So market size is important. Differentiator. What is it that's different about your offering, right? How are you different from competition? What is the moat? If you're exactly another me too, then VCs will wonder that, okay, what is it in you that is different? So of course, competition is also important in the sense that if the market is too crowded and there's no room for too many players. If it is a crowded market, but there is room for many, many good players, then it's fine. So we kind of gauge that. And how scalable is this business? Somebody talked about growth here. Is it capable of providing 100x return? Now you understand, right? Why does a VC look for 100x? Why not 5x? As long as you give me, now suppose I meet a founder who says, yes, I'm looking to raise 1 million. I can easily show you that I will be worth, no, suppose you raise 2 crores and you're at 10 crore valuation. And you say, my goal is to get to a 3 crore, 5 crore revenue in the next 5 years. That's not exciting to a VC. The VC says, where is the vision? Yeah, where is the, you should be at least able to envision that you can grow this company to 100 crore, 200 crore, 500 crore. If you're not thinking very big and you're thinking small, then VCs will not be interested. Any questions here?
So I have one quick question.
Sure.
The thing which has always puzzled me as to why amongst your 20 companies in your 100 million portfolio that you bet so risky that every company should want 100x return. Like let's say a product market fit is nearly there, the founders are good, the market size is reasonably good, you are achieving a 5x, not 100x. Why aren't VCs running away from these companies?
Yeah, so like I said, if you go back to that chart, if you go back to this chart, essentially, if they start looking and saying, hey, this company is going to give us a 5x, that's great. Angels sometimes bite that. Angels say, okay, I get my 5x return, I'm happy, right? They're okay with it. But VCs have to return, imagine they have to return 5x of their capital. If I have raised 100 million and I have to return 500 million, or I have to make 500 million, that's the goal. Think about it. If I start investing in 8 startups or 5 startups, which are saying, okay, they'll give me a 5 to 8x return, I don't know which, I can make only 20 bets. I can make only 20 bets. And I don't know which of those 20 is going to give me that 500 million or 100 million or 200 million. If I start making bets knowing that this founder or this company is only capable of 5x or 10x, then I'm losing chance of finding that one winner who will give me back my entire fund, right? The entire fund, they call dragons. One startup which can give back the entire 100 million, that's called a dragon. It's not like VCs will not take a bet. VCs will not take a bet if you say that I will give you 5x return. You should have a vision of 100x return. Of course, you are seeing here the data itself that most of them fail, 50% fail, 20-30% give 1 to 2x, and then another 20-30% give 5x, and then 10x, and only 6% give you that 100x or 10x plus. If 20x, they're very happy. But if you can, given that you can do only take only 20 bets, you cannot afford to take a bet which is giving you only 5x return. Because if I take multiple of those bets, then I'm going to be in trouble if I don't get that one winner. You get it, right? Probability, basically.
So sometimes in the future, if you, and I don't know if it's fair for me to speak on behalf of the IIT.
No, you can speak. Speak
these guys, including me, are deep tech startups.
Yeah.
Deep tech startups, we don't typically have good salespeople to give the pitch of 100x. Yeah. And the case of this pancreatic cancer is a very cool example you gave. Like if somebody were to come with a solution for pancreatic cancer, typically a VC will not invest in it.
Yeah, yeah.
So where does that fall into your general industry focus when you want to get the 100x and shoo away people in deep tech or who are not typically a B2C here?
No, interesting. Interesting that you brought it up, and it's very sad today that in India we don't have deep tech unicorns, what we call, right? The ones that have made it to a 1 billion valuation. Having said that, in the US we've seen a lot of good successes, and funds like ours. In fact, we are running with IIT Madras. We are looking to run a deep tech club where we're saying, let's incubate, let's see how VCs can start investing in this space, and not just say that this is a small market. We figure how you go global. We figure how you expand if you're into one industry, how you can service other industries, basically ensure that the market is target market size is large enough, and therefore there is potential to grow. There is potential to grow to that size. Having said that, we have invested in deep tech startups. I'll give you examples. Ethereal is one. Euler, which is an electric vehicle startup. Currently, we just invested in Pixel. It's a space tech startup. It's a 0 or 1, either they make it or they don't. We are happy. In fact, it's in our mandate right now. Yesterday, the one that we were evaluating, a robotic startup, again a hardware startup, a deep tech startup. So as long as your deep tech startup can show that there is a market out there which is large enough, that's all we need. And if
100x won't be considered in your next slide, you had the list, or how?
Yeah, let's go through that. Give me a second.
Okay. One question on the previous slide. Could you kindly elaborate a bit on the moat?
Which one? This one? This slide?
No, the previous slide.
Yeah. This one?
What the moat? Can you kindly elaborate on that question?
yeah, what's the moat? Basically, sorry, it's called what's the moat, but this is just a typo. So basically, what is the differentiation? Now, if there is one space tech startup and the other is doing exactly the same thing, then we're saying, what is the competitive advantage? You should have some competitive advantage. Now, I'll give you the robotic startups that we were evaluating yesterday. His differentiator was two things. My robot can work outdoors. There is no other robot that can work outdoors today. Number two, he said, my robot can go over slopes. No other robot today can go over slopes. Yes, maybe 5-6 months down they can, but today this is my differentiator and I'm going to really move fast with it. So it just has to, I mean, I'm just giving you that one example, but as long as there is something that is giving you an edge over the other competition, that's all we're looking for. But there has to be some differentiator. It can't be a me too. Like I'll give you an example. If so many startups solving the same problem, you already know there's no space in that industry. There's already that, like you say, that boat has sailed. That so many startups have already solved that problem. Now, tell me, if you come and say I'm starting a food delivery business, will we invest? We know there's already a crowded market. There's Swiggy, there's Zomato. What is your differentiator? Why would we invest in it? Unless you really can show that you're doing some drone delivery or some real differentiator, we're not going to invest in it, right? So there has to be some competitive advantage, some differentiator there. Constraints in our business. I talked through some of this, but let's go through quickly. Let's not kid anybody. VCs are in the business of making money. It's not a social service. It's not something. Yes, some VCs have a mandate. Let's say we'll do investments in environmentally startups which are positive for the environment. Some people say they'll do consumer brands. Each one has their own investment thesis, what we call, which means they will focus on that area. But clearly, VC investments is not a social service. They're not looking to do good for the world and not get anything in return, right? They have to return back the money. It is a money and it's a high risk category. Therefore, we have to give back high returns. It cannot be 10, 12, 14% return that you can get in on mutual funds and fixed deposits. We have to give them a much higher return, IRR.
Ma'am, sorry to cut you in between, but can you elaborate upon CSR funding?
CFR, CSR or CFR?
Ma'am, CSR funding.
Yeah, CSR is your corporate budgets, which are for good, right? That CSR budget is great because if you're looking to do some good and you can convince them, you can go after the CSR budget. So there are startups like helping women in rural India. Those kind of startups can definitely tap into CSR budget. See, VC funding is different. If you want to go for grants, like if you're an edtech startup which is doing some impact work, you can go to a Michael Susan Dell Foundation and take a grant. So there are ample grants available if you're doing good, but then they don't expect you to return the money. It's a grant, you take it, you do good. As long as you're impacting society in a great way, good for you, right? And they are happy, you're happy, everybody's happy. So that's CSR and grants. Don't mix that with VCs. VC money is something when you take, you have to ensure you give them good returns. That's kind of definitely the goal. What are the constraints, right? Now, suppose you come to me. Why will I say no? If I already have a portfolio in that space, or even if your idea is in my portfolio's roadmap, I cannot invest because it's conflict of interest. Will I help you or I'll help my other portfolio? For example, if Unacademy is in the education space and they are in our portfolio company, if Unacademy has something in their roadmap also, I would likely not invest in that space because I know that it's in Unacademy's roadmap. So anything which is competition to our existing portfolio, we will not invest. Secondly, if it's not in our thesis. So every VC has a thesis. I will invest in only B2B SaaS. I will invest in only B2B SaaS global. I will invest only in deep tech startups. There are funds, by the way. There's one recently, I think Sienna Fund, they only invest in deep tech startups. So everybody has a thesis. In our case, we are a little sector agnostic. We do invest in tech startups. We do B2B and B2C. So about 50-60% of our portfolio is B2B and another 40, 50% is B2C. We do not invest in consumer brands. So if you come and say, I'm launching a bira, we can't invest in you because that's not our investment thesis. Yeah. So this is how we eliminate. We say, oh, this doesn't fall in our thesis. We can't do it. Sorry, it's a competition to our existing portfolio. Sorry, we can't do it. Biotech startups, a lot of them very, very exciting, doing some great work, but gestation period is extremely long. We have to return our money in 8 to 10 years, right? If we know that the startup is not going to make it in 8, 10 years, we cannot invest in it. So very long gestation period also we can't do. Undifferentiated plays, like I mentioned, we can't do. And if it doesn't scale, we can't do. If there's no potential to scale. Deep tech investments find it generally harder to raise money. Why? Right? Exactly because we have not seen too many unicorn success stories. We have seen success stories from IIT Madras, you'll have Aether and a lot of good examples. What is that other one which was very exciting? The one with drones. Some really good startups have come out of IIT Madras as well, but they find it deep tech startups a little harder because we've not seen too many success stories. And clearly in India, VCs are trying to change this, right? That's why we are forming this deep tech club and seeing how we can ensure that we have 1 or 2 success stories out of India as well. Now let me give you an example. These are 3 examples of our real portfolio companies. I'm sorry, I can't share the names because of confidentiality issues, but I want you to actually look through and understand how this works, right? So Blume it was a B2B hardware startup. Blume gave them 300K right at the beginning. That time, those days, Blume used to write small checks, 300K at $1.5 million valuation. Their revenue was 0. We just saw that this is a great product. We did some diligence with people in the industry. We took it to customers. They said, good, we will buy this. It looks good. Current valuation. Today, this company is doing 50 million revenue and they're at 400 million valuation. Okay, it's a deep tech startup. Deep tech hardware startup. So they're at 50 million revenue doing 400 million valuation today. Potential exit. We are thinking in the next 3 years, we are expecting them to be at $1 billion valuation with about 100 to 150 million in revenue. And our exit, what will our exit be? We will get almost $30 million out of this. This is going to be one of our dragons, which will pretty much return our entire fund. You understand, right? Any questions on this? This is important for you to understand because you will see the growth path here.
So how many years it took?
10 years. 8 to 10 years. 8 years. 8 years for exit, I'm saying 8 to 10 years. Right now, currently I would say about 7, 8 years already. 7 years, 8 years to get to this 50 million revenue.
Okay, thanks.
Yeah, so with about 20% holding when you entered, when you exit at a 1 billion valuation, you should get back like 200 million or 400 million.
No, what happens is, I'll take you through a whole example of how it works. Basically, you get diluted in the rounds. If you don't invest, like I talked about that reserve ratio, right? You have to keep a reserve ratio and you have to keep playing in every round. If you don't play in every round, your stake starts getting diluted. So while I may start with having 20% stake, by the time so many investors come in and I don't invest in the follow-on rounds, I may end up at the end only with a 5 to 6% stake or 8% stake.
This is typical even for a VC because it looks like quite low, right? 2-3% maybe at this stage. So
Sorry?
The right track for a startup is to go like this in multiple rounds of investments. So even when you enter as a VC initially, you have diluted. So the multiple rounds shows up a very good potential growth track.
Yes. So what we do is we do something called exit modeling. Anytime we bring an investment, we create a whole chart and I'll show you that chart. It's important for you all to understand how we do the exit modeling. So you should do your own exit modeling and see whether it's making sense or not. And founder at the end we always ensure a good VC will ensure, and good angels who understand will ensure, never take too much equity. For you all as founders also, very important at the early stage, don't give up too much equity. I'll take you through numbers. I have all the numbers here, but essentially at the end, imagine if you're at 1 billion valuation, you've been working 10 years. And if you don't even have, as a founder, 5% in the company, what is your motivation to be working hard and giving investors exit? So we ensure that dilution of founders is not too much. That way, even at the end, the founder holds significant stake to remain motivated. Right? I'll take you through a whole exit model. I have it here and we can go through it. Founders who scale, how do we decide, right? And how do they give us exit? Founders with insane ambition. They have to be, only way people can achieve, they have to be like, I don't care, I will not sleep, they only think, breathe, eat, work. They are just like so driven, and so have that hunger in them to prove themselves. Willing to put extra hours for years. So highly skilled and also highly skilled at whatever aspect. Ability to attract talent. I told you, some of them actually judge you based on how you manage to attract good talent and leaderships. And of course, flexibility to respond to market. How quickly can you pivot? Very few startups start and go on with the same model forever. We are one of our hardware startups which started off, and they're very successful now. They started as a hardware startup. They slowly converted to hardware as a service, and that's where they raised some really high rounds. So the founder has to be willing to see and pivot. Even I think your one of the IIT Madras startups, Unifor. It was an earlier investment with the IA and Indian Angel Network. And the founders, the investors, who's one Mr. Money, he's based out of Chennai, in fact. Mr. Money was telling me, he said, they were in fact into this voice IP. And he said, they were just selling hardware, and we told them you pivot. So from 5 crore revenue, they went down to 1 crore revenue and pivoted the model to what it is today. If the founder was not adaptable or willing to respond to the market, that company could have failed. So that adaptability and willingness to quickly make decisions and pivot also is something that VCs will look for, right? Not motivated by money. If the founder says my only goal is to make tons of money, it doesn't really work, because they can get frustrated. Money it may take much more time than expected. We hear of success stories, but we have companies in our portfolio 10 years and going strong and still not made it anywhere, right? So if money is your motivator, it will be very, very frustrating. It should not be. The need should be to prove yourself in other ways, not just making money. Of course, money is there. Everybody wants money, but it should not be the primary motivator. Inter-founder chemistry and trust, extremely important. We've seen very good startups fail because the founders have a issue and split. So best of ideas, best of startups can fail if you're co-founder and you don't have good chemistry and trust. Very, very important here. Sense of purpose, as I said, should be a goal bigger than money. Yeah? I think these are all like things that you can go through it. Let me see if there's anything else. Emotionally challenging. Yeah, single founder is a problem. You should think through it, because the journey is very, very tough. And as single founders, I'm not saying people don't make it, people do make it, but it's definitely much, much more stressful. If you have a co-founder, CTO, CFO, it makes life much easier. Sometimes these are red flags. If slightly older founders, sometimes they have lifestyle needs. You're already used to a certain lifestyle. Are you okay to compromise on that lifestyle? Ivy League founders, people who come from big pedigrees, Harvard, Wharton, great, they're very successful, but a lot of times they keep comparing. If in 2 years they're not successful, they'll say, oh my God, I could have been making $1 million per year. So they always are comparing it to their high perceived opportunity cost. A single founder, very emotional journey. High flying corporate executives, not to say there are always exceptions, but sometimes they are too practical. They won't take very high risks. So, and yeah, even lack of focus on tech or ability to think commercially. All these are kind of things that we look at where, you know, we see red flags basically. I think this we already talked about, market size and dilution, basically to ensure that the market size is large enough, right? Stages of a startup and valuation. Let me see how we're doing on time. Yeah, so let's look at this. These are important ones. Maybe we go through the exit model and then we wrap up. So on imperatives for investors at various funding levels, right? So what is important at pre-series, Series A, it's mostly team and market size. At Series A, we look at product market fit before Series A. Then at Series B, we look at metrics, growth, and that's so on. Profitability, path to profitability. You still, even at Series C, if you're not profitable, it's fine. You see prime example in India, Flipkart and stuff, but as long as you show a path to profitability, I think that's good. Now, this one is what I was talking about. Different stages and what the valuation and what typically you should dilute. This is like a thumb rule you should go with. We don't have B2B hardware specifically here, but as a thumb rule, just use the B2B SaaS ARR here, and that's good enough. You can kind of use that as your thumb rule for hardware startups. At seed stage, when you're first starting off, please go to friends, family, and people you know. Don't go to any institution unless you really know somebody and they're willing to give you a 50 lakhs to 1 crore at a 10%. So if you're taking 1 crore, you can go at a 10 crore valuation, like a thumb rule. And for that, you don't need to be, you can be even at 0 to 50K of ARR. 50K basically is like 20-30 lakhs or something. Annual revenue, that's good enough. When do you go for an angel round? Angel round, you need to have some revenue. Typically, some revenue is good. You typically raise, say 3 crores is kind of the average. Again, don't give more than 10-15% equity, right? So at this point, you've diluted say 10% in the beginning. Typically, the good founders will even get a CCD. They will not fix the round at friends and family. They'll just do a CCD. Means a convertible note with some discount if they raise quicker or later. Then when you have achieved product market fit, Series A, pre-Series A, this is where typically Blume comes in. And what do we look for? Some revenue. If you're doing about 250K, which is about 1.5 crores kind of revenue, it's great. And how much would you raise? Typically is about $1 million for about 15 to 20% stake. So this is kind of where we come in. It's kind of our sweet spot. Most of our companies, we help them grow to Series A. It's almost like an 18-month. Every journey, say 12 to 18 months. And within 18 months, you should be, so in fact, a lot of founders joke that they after a certain stage, they spend most of their time on 2 things, hiring and raising money. Everything else, they have a team to take care of. The CEO or founder's job becomes raising funds throughout the year, networking. You don't go out in the market only when you need to raise funds. You need to constantly be talking to investors, getting advice, staying in touch, keeping them posted. And investors told you, looks interesting, but it's early. Keep them posted, send monthly updates, send them, hey, I just want to update you on my progress. So fundraising is almost like a full-time job, I would say. Don't stop talking to investors when you don't need funds. Keep talking to them. And if funds come to you, even if you don't need them, if it's funds are coming to you, good to raise them and keep them in the bank. In a bad time, it'll always come of use. So don't say no to money if it's coming at a good valuation. Series A, typically you're at a 1 to 2 million ARR. VCs come in here and you are typically raising 5 million, 3, 4, 5 million. And here you give a little larger percent, 30 to 35% stake. Finally at Series B, again raise about, you're at 5 million ARR, you raise about 8 to 10 million and you give up 20 to 30% equity. Any questions on this?
Yeah, ma'am, I have in dilution, ma'am.
Yeah.
While coming up to Series A, what is the left for founders?
No. So if you look at it, so just say 10, 20, say you're doing 10, then you're doing 15. So 10, 25, and then you're doing another 20. So 45, and then you're at Series A. So 45, 55, 70%. Yeah, so if you look at it, typically at Series A, if you as a founder owning 50% of the company, you're in good shape. You're in good state. If you're building a large company, right, even if typically you look at all of these, even some of the most successful startups in India, most of the founders at the end state where they are exiting, they don't own more than 5%, 5 to 10% equity in the company. So that's kind of the growth chart you will see. And sometimes if by chance you've diluted too much in the first round, some founders, please do not give away 30, 40% equity in the first, then your company is right there in big trouble. So be very aware of, and color of money is important. Please understand money, there's enough money in the market. You can go raise from, there are hundreds of people who are willing to give you money, but color of money, where is that money come from? Who's that money? Who's giving you that money? What is coming with that money? It's not just money today. What else are they going to do for you? Which is apart from giving you money, what else can they help you with? Can they help you with connects? Can they help you with learning? Can they help you with mentorship? Can they help you with much more? So VCs have to do much more than just give money. So please understand, early stage, don't make mistakes of giving too much equity, and also whom you're raising from is extremely important. Sometimes we even go with the conviction, oh, it's this fund who's raised, they've invested, we should look at it. Because we know the credibility of that early investor or that angel or that fund. We've seen startups coming from Hyderabad where very messed up cap tables. Somebody's owning it, we don't know where, it's what kind of money, it's a big problem. So just make sure you know whom you're raising from, they have good name, reputation in the market.
Ma'am, I have 2 quick questions.
Sure.
So the first is, let's say if the first 2 rounds are skipped and the founders have self-funded it.
Yeah.
And the ARR is somewhere 100K.
100K.
Not 250K. It's gone past the 50K.
Yeah.
Is it worthwhile to pitch to somebody like a Blume for a 15% dilution?
Yes, of course. There are founders who have done that. Many founders, in fact, they don't, if they can self-fund, say you're from the corporate world, you made some money, you're bootstrapped, you're taking it very slow. And if you see that there's a good path for you, that you can grow, this company has great potential and you have customers, you're doing well, yes, of course, you can come in, and that's great because then you don't need to be diluting, you've not diluted earlier, right? And many startups do that. If founders are experienced and they've made some money, they bootstrap, they don't raise.
So which actually is a corollary to your previous slide, because in most cases, maybe even including me, that for you to reach, it's in the slide before. So if you go one more, please. One more. Yeah. So if you fit in here, the people who will literally go straight to your Series A would definitely be a second round, third round, and 45 years plus, or at an Ivy League. So I've been faced with situations where the stay hungry, stay foolish has probably worked against. Okay. And
Yeah.
you can just forward it back. So that's a sort of a gray spot area, and which I would like you to address, because, and if it happens to be deep tech, then you're screwed. You're literally screwed. So they're like, why didn't you go and ask earlier? Maybe you should get to 500K mark. You're confident enough to do it. It looks like lifestyle. You do it yourself. No, why do you come to me here?
Yeah.
So I've been faced with this situation time and again. I'm pretty sure I'm speaking for most of the people at IT. The other last question I have is on the ARR itself, which is the revenue. I mean, the source of revenue is vital. Today's revenue comes from services, doesn't come from a product.
Yeah.
So by you saying I've got 100K of service revenue and your margin is at 5% or 3%, do you really look at source of revenue? That's actually a completely second question, but these are the two questions I have. Thank you.
No, fair point. I think you kind of brought up a very interesting point that there are founders who are at 45 plus who have who have been there, they've bootstrapped, they're doing well, and tendency is to say that this is a lifestyle business. As long as, see, if your growth is not showing a steep growth curve, if you're showing like a 10, 20, 30% year over year growth, then they say, yes, great, but this can be a lifestyle business. Why? And you should also question yourself, why do you want to raise VC funds? Are you willing to run that treadmill for the next 10 years? If you are, and you see potential that this, whatever, 100K is going to grow, has the potential to grow 50x, 100x, then yes, then I'm sure VCs can see that, and they should see that fire in the belly. They should not see that, oh, this guy is so comfortable. Will he be, a lot of times they say, will he really be willing to run 10 years non-stop on the treadmill, right? So kind of as long as you show that you have the hunger, or you're trying to prove that, yes, I can. There are, in US, there are extremely successful Indian entrepreneurs who have made it second time, third time. Sometimes people question it, but see, there are always exceptions to the rule. This was broadly saying this is how VCs look at it. But if you show that there is potential, there is no harm. Some VC will take it. You just have to be relentless. There are startups who have come to us who have pitched Dunzo, for example, Kabir Biswar. I don't know how many of you use Dunzo, whether you have Dunzo in Chennai. I think you do. Dunzo, he pitched to 100 VCs before we invested in him. And after that, there's Google and 100 others who've come in. But don't get this. You should be prepared that at least 20 VCs will say no. And it's fine. You should continue trying, and somebody will, if they see potential, that's it. Then you're set. But don't give up just because a VC says no. You probably know your business much better than we do. And your second point is, you said product, right? Yes, if it's not a services, it's a product company. If you can show recurring revenue also, it helps in the sense that if you have some contracts, if you have some AMC also. So you sell the product, but you have an AMC. So you have that continuous revenue coming in because you're maintaining those products. That's also good. It doesn't always, so the robotic startup we are looking at is looking at robotics as a service, but they're also looking at so they have two revenue streams. One is actually selling the robot. If they're selling the robot, then they have AMCs in place. And if you show that annual AMC revenue coming in, that shows recurring revenue, that's great. Yeah.
What's the advantage of CCD?
CCD just helps at a very early stage. It's very hard to fix valuation, right? We're saying, okay, 1 crore you take at 10 crore valuation. And if you think, no, I believe that I should be getting a higher valuation, but there's no way to prove it because you're very, very early stage. Then you come up with a CCD and you give a 15% discount or something. So you say that in the next round, whatever I raise. So suppose you raise series, if you raise seed at 3 million, 5 million valuation, you can say, I'll give you at a discount. Because when you're not sure about, and you as a founder believe that this is worth much more, it's better to go for a CCD. And nowadays, India VCs are very open to doing CCDs in the initial stage.
I have one. Hi, Pradeep here. So in this cap table that you've explained and other things, let us assume either someone on the angel stage is from a family office and is kind of willing to back us up until we get to a VC stage, whereas maybe just before commercialization, to that level. And I think he will acquire about a overweight of about 50% of our company, maybe in 2 to 3 rounds, approximately, even from this cap table, I could kind of assume. So how will VC look at it when this is with one person, like one family office or one angel investment person? Would it be taken as a positive sign, or will VC feel that it might be an overweight on the investor side? And then how will you look at the cap table?
Yeah, you don't want an overweight. You don't want too much money from the same person. One is, the more people come on your cap table, the better for you. I'll tell you why. When you're in trouble, you're not dependent on that one person. You have, don't get 100 people on your cap table, but you have at least 2 or 3. Maybe family office is good. Get one institution, because like in COVID times, I'll give you an example. The ones who had to survive, they had to have a larger runway. We could be supporting everybody, right? But people who had 2 or 3 other investors on the cap table, everybody pitched in to help them increase their runway. The pandemic last year was crazy. That basically proves to you that don't rely on one person. If that one person can't support you when you're down, then it's a problem. So please have 2, 3 different investors. It helps. And color of the money, right? Yes, family office is great, but having institutional money definitely validates it even better. So if you have a choice between the two, take the institutional money, because, or question, how long can they support you, right? How long can they keep you and keep pumping money into your business? It's not negative. VCs will not look at a negative. If you're comfortable and we love the business, we're okay. We'll clean up the cap table. We'll negotiate. We'll do all that. If we really love the business, everything is okay, right? It's not a big problem per se. It's not like we'll make a decision, oh, we can't invest in this because they've taken too much from the family office. So it's not a no-go, but for your sake, it's better that you take money from 2, 3 different institutions or players.
Yeah, got it.
Thanks.
Quickly, will you touch upon Founders Fund? Is it something similar to an angel or seed within Blume, or is it quite different?
Yeah. So I'll quickly touch upon Founders Fund and why Blume Found. So for those of you who don't know, we recently launched something called the Blume Founders Fund. It's a small carve out of our total fund. Why did we do that, right? It's because we as Blume are founders first. We've always looked out for our founders. We have so much founder love. We are a relationship-based organization where we believe in our relationships with our founders and CXOs. So as we've grown larger, we can do, like I showed you, we can do 20 checks, right? In the $1 million fund, 20, 25 checks. When we do that, we can do 8 checks a year, but we get so many good startups coming to us, and we have to say no, because we're like, oh, there's a conflict here, there's a issue, this is too early stage, we can't take the risk, we can only do 8 bets, we have to make sure that these are really, really, really exciting. So a lot of times we have to say no. In that, what started happening was, our ex-founders, say our Fund 1 founder, we are at Fund 3 now, by the way. Fund 1 founder came to us and said, hey, I'm starting off. We would love to put in that. Karthik is like, hey, we know him so well. I wish I put in some, but he has something, he's working on something which is of conflict to one of our portfolio companies. So we can't invest. But for the relationship, to keep the relationship, we said we want to do these small checks to keep these relationships. So be it our ex-founders, be it our ex-teammates, or be it one of our CXOs of our portfolio companies, by default, unless there is an issue, we will give them a small check from Blume Founders Fund. Second is, if our founder highly recommends a startup, then we will invest in them. I'll give you an example. 2 examples I'll give you. One is Chingari. It's a video app. We've never invested in that space. But for us to experiment, our founder called Jasminder Gulati, is the founder of Nerve Floats, which we sold to Reliance. Jasminder called us and said, hey, I'm putting in this money. You have to invest. It's very exciting. I'm putting in my own money. I'm going to mentor the startup. Blume has to be in this. Of course, Blume can't write a 1.5 million check just like that. Quickly, in 2 days, we said, fine, Blume Founders Fund will put in some small check, right? Similarly, Deepak Abbott of India Gold. India Gold, Deepak Abbott has been known to us for 8 years. He's done many sessions for our product heads of our portfolio companies. He's buddies with Blume, and he's starting India Gold. We couldn't invest because we have some conflict issues. And we said, we know Deepak so well, we want to keep that relationship, therefore we will invest. So Blume Founders Fund is for our own founders, our own ecosystem players in the Blume portfolio companies. Third is, if they come through a high referral of our founders, where our founder is also backing them, then we will invest in it. So just broadly, that's kind of the idea, that we want to stay nimble, we want to keep those relationships, we want to invest in startups which are, and we as a fund now we take time, we have a IC, pre-IC, we have a process. But we want to keep that nimbleness, and therefore we have Blume Founders Fund, which does very small 25 to 100K checks, but we can do 40 checks in a year. So that's where it is. I hope that helped.
Yeah, definitely. Thanks.
One question that is on dilution or raising more money. Like, how can one prevent the dilution? Maybe let's say keep the dilution at lower end.
Yeah, so you have to negotiate with the people coming in. If they are good angel groups like Indian Angel Network, Angel List, Let's Venture, they all know they will not dilute, they will not take too much. Suppose at seed stage, they take 30% equity or 40% equity. They know that this company VCs will not touch. And if VCs don't touch or not touch, but it'll be a major issue, they also want the founders to become successful, right? So negotiate it. If you can stretch and try and get numbers which are a little more attractive, whatever it takes, but yeah, don't dilute too much too soon.
Or is it possible to get more fund at particular stage? Let's say seed stage more than 1 crore.
Yeah, 1 to 3 crores, 3 to 5 crores, up to 5-6 crores. Yeah, possible. It's not this is not hard and set rule. This is just broad guidelines. There'll always be exception. Mukesh Bansal can walk in and first round take 5 million because he's Mukesh Bansal. No? So there are always exceptions. If you're a proven founder, people will come to you and give you funds. If you're doing something great, exceptional, you don't have to worry. I think people will come to you. There are the VCs are constantly watching out for. So write blogs, get your content out there, make sure that people are aware and know that you're doing this. Just keep the buzz alive. And like I said, when you meet a VC, for example, and someone or an angel, and he says you're early, keep him informed, keep in touch, keep coming back and updating. Yeah. Let me quickly go through this exit model. I think this will be very useful to some of you. It's a little longish with numbers, but if you'll have patience, I'll be happy to take you through it so you understand how the stake works. So this is, let's go through from pre-series A. This was the days where Blume used to put smaller checks, 500K. Now we do more like 1 to 1.5 million checks. This is in rupees and the other side is dollars. That's the only difference. There's no other difference. So in pre-series A, we invested in a company, 2.5 crores, right? Somebody else came in with 1.5 crores. Total investment was 4 crores. Pre-money valuation, 14 crores. Post-money valuation, 18 crores. And that, the founder diluted 22%. And Blume's stake was 14%. This was the early days. Now it's different. So this was kind of where it was. Okay, so founders diluted 14% in pre-series A. Now move to series A. What happened again? In this fund we had 1:2 reserve ratio, which means we will invest twice in this company. So look at this, okay? Somebody had asked here, why did Blume have such a small stake when the exit was so huge, right? Here, if you see, Blume had 14% stake starting. By the time Series A happened, if you look at, Series A, we put in again 2.7 crores, right? Because we had a reserve ratio that if you do the next round, we'll come in again with the same amount. So we put in 2.7 crores. Others came in with 24 crores. And the total round was 26.7 crores. Pre-money of 60 crores, post-money of 87 crores, 86 crores. Total dilution 30%, Blume stake was 12%. So Blume actually, in spite of investing again 2.7 crores, our stake went from 13.7% to 12.6%. So Blume had invested total 5 crores in this company. And yeah, right. And total investment, yeah, I think this is it. So Blume Series B. Now, if we go to Series B, Blume did not put in any money. We didn't have any reserve ratio. We couldn't invest more money in this company, but the company kept raising. So company did in Series B, what did they raise? They raised total round 75 crores, which is $10 million they raised in Series B. At what valuation? At 300 crore valuation, which is $42 million valuation. And total Blume stake, if you see now, came down to close to 10% because we didn't play in this round. So now the valuation is at post money is 300 crores. So if you see Blume stake was 5 crores. 5 crores on 300 crores is 5 crores. Yeah, 5 crores is what we had invested, and post money valuation was 300 crores. So 5 by 300. Then we go to Series C. Here what happened in this company, they raised a total round of 150 crores, which is $21 million at a 700 crore valuation. 700 crore valuation is basically $100 million. So this company became $100 million worth, and total they diluted 20%. So finally you come here and you see, yeah. So Blume stake here, it's continuous. Blume has put in only 5.18 crores, and we own Blume stake is about 10%. So our value, our current value of our investment is at 70 crores. Then we go to Series D. In Series D, what happened? They raised a total round of 250 crores, which is $35 million at $235 million valuation, which is 1,650 crores. And Blume stake became 8.4%. In 8.4% stake, Blume still our value of our investment, which we put 5 crores investment we had put in Series D, that 5 crores is at 139 crores. So 750K our total investment, that's at $20 million. Yeah? Final exit for Blume was this company raised 2000, they exited. So they got acquired. They got acquired for 2,000 crores, which is $285 million. And Blume had about 8.5% stake. Now at 8.5% stake, we got 168 crores, which is $24 million. So this example basically shows you, in this model, we were a $60 million fund. Now, the $60 million fund, this startup gave us $25 million exit. So it's called a quasi dragon. Dragon returns the whole fund. The dragon will give us entire $60 million back. In this case, anything above 20x is great. Anything which gives us 20x return of our investment is a great investment. Any questions on this? I'll be happy to share these slides with you. You can go through it, play around with it. I'll be happy to share it.
Hi, quick question. Paridhi here. From your Series B to Series C, I mean, Blume stake should have diluted a little more, right? How has it gone up? Is that a typo? 9.95% on Series C?
Yeah. That's a typo. It would have gone down because we raised, they raised 550 at total round was 150 crores, right? Let me see. Total round, yes, sorry, that's a typo. It should not be so much. It should be lower. I'll change and send it to you. Yeah.
What is the time window to get your 168 crores?
Typically 5 to 8 years, 8 to 10 years, 5 to 8 to 10 years. In this case, I think it was 6, 8 years. But yeah, I think most of the time it takes about 8 to 10 years. That's why the VC life is 10 years. And that's why everything is 10 years. It's a long-term game. You can't expect in 3 years miracles to happen, but we have seen some good numbers in 6 to 8 years. And now that cycle is slightly reducing. It used to be 8, 10 years. Now in 5, 6 years, we are seeing some good exits. Yeah. Let me take you through. I think we've done this. Basically, so mini quarter dragon is what I was telling you. But let me take you through this. This is a live example of our fund. In fund 2, we had a $60 million fund. Okay. We kept aside 12 million for fees. So therefore, our investable amount was 48 million. We had a reserve ratio of 1:2, which means for every investment we make, we will keep 2x aside in case the company is successful and needs more money. We'll be happy to play in the next round. Our average check size was 500, and therefore we could make 30 to 35 investments. That was fund 2. Now fund 3, it's different. Size of exits, we had one exit which gave us mini quarter dragon, which is $15 million exit. Average number of diluted rounds before exit, there were 4 rounds. They raised 4 rounds. And resulting stake was, exit valuation was greater than 200 million. So that's why if you go to see, a VC will look for an exit where your company valuation should be, at least you should have a vision to take your company to a 200, 300, 200 million to $500 million valuation. That's when a VC who owns 10% stake will get 20 to 30 million, right? And that's the goal. Not necessarily, most startups don't deliver this, but that is the goal. I think basics of a term sheet, this we can go through, but some clauses that you should just understand, or I'm not an expert honestly in term sheets. So, but we do have people on our team. If there is a requirement, I'm happy to get somebody to do a session specifically on what you should look out for in term sheets and stuff from our team. But essentially, broadly, these are just rules or key terms in the term sheet. Liquidation preference. Sometimes you should note investors ask for very high liquidation preference. You should be wary of that. 2x, 3x. 1 to 1.5x is fine. Basically, it means that if the company is going down, shutting down, or an exit, the investor has the right, whatever money is coming in, has a preferential right to get 1x of his money back. Board seats typically, or observer. As you grow, first we take a board seat, but as you grow and you get other larger investors, we sometimes give up our seat and become a board observer, meaning we don't have voting rights, but we just remain as an observer. Pro rata right, meaning we retain the right to maintain the stake by putting in more money at a future valuation. So if I own 5% today, when you're raising the next round, I should have the pro rata right to put in money to hold my 5% stake. Right of first refusal, meaning if you're raising the next round, you first ask me if I'm interested. If I can't do it, then you go to others. But I should have a ROFR. It's called ROFR, right of first refusal. Ask us to match if you have another offer. Tag along. If founders are existing, then they should take the investors along. So sometimes founders say, I'm selling my stake to somebody. So then the investor has a tag along right that if you're selling your stake to somebody, we should also be able to join you. Drag along, never being used, but there are sometimes a clause. I've very rarely seen drag along being used. Drag along is basically founder can't, after a point, say 8-10 years have passed, and the founder is not giving an exit. I'll give you an example. We had a company, not at Blume, but at IN, where the founder was living a great lifestyle. He was profitable. He was doing so well, but he was not thinking of returning investor money at all. It became 8 years, 10 years. And the investors said, hey, if you are struggling, fine, we write it off. If you're not doing well, we understand. But you're doing great. You are making profits. You're driving BMWs. You are like living the life and you're not thinking of giving us an exit. In that case, The founders have a right to find an exit, right? That's called drag along, but I have never seen anyone use drag along really. Exit, founders are guaranteeing that they will try for an exit within a limited period of time, say 10 years. Information, we would like to get mandatory quarterly, monthly, those kind of updates. Affirmative rights is basically whenever a key decision is being taken, you should at least run it by your investors. For example, on issuing more shares or ESOPs, or hiring like a CTO or a CXO and giving him like a huge pay, certain big, or you're pivoting your business, certain very big changes, the investor has an affirmative right to at least you should run it by them. All representation and warranties at all times of entry, you should share information with founders is correct. That's what you're saying. That's it. So any questions on this? I'm not the expert, but I can try and help answer this. But definitely, Kalyani, if you're on, you should definitely do a session on,
term sheet. Yes, yes.
Yeah.
Plan sometimes.
Okay.
Yeah.
So this was just a poem that we often put it up in our office, and Arpit from our team is very passionate about this. If you, just take a moment to read through it. So firstly, I think this clearly, we've seen so many of our founders, we've seen their struggles, we've seen them relentlessly fight, bounce back. Startups that we've sometimes written off have come back and performed fabulous. So it's just because the founder never gave up. So basically just trying to say that, yes, it is a very, very tough journey as a founder, but you should continue and know that this is where greatness comes from. So we all like this. That's why I thought I'd share with you. I think that's about it. Happy to answer any questions you all have, or anything else that I can cover, which I may have missed.
You were about to share about cash flow.
Yes, cash flow, actually, I don't have a slide on that, but essentially, maybe I can share something with Kalyani. We do have like a cash flow sheet that I can share with you all, but I'll just write it down that way. I can share with you. But essentially, thumb rule is when you create a business model, you ensure you put in what you're expecting as a revenue. Say months, put it as months. Say 12 months, 18 months, or quarter. Actually, best do it as quarter, Q1, Q2, Q3, Q4 for 2 years or 3 years. Put in 18 months for sure, best to do 18 months. Put in the revenue you're expecting, put in your expenses, and then see what your cash flow is going to look like. And you'll have negative cash flow, right? Because you'll have minimal revenue, you have fixed expenses. Now, for example, then add a column which says all your negatives. So month one or quarter one, you're saying you're going to lose 8 lakhs. Quarter two, you're going to lose 10 lakhs. Add up those 18 months together, put a buffer. Say, suppose, it becomes little worse. Add another buffer of 3 months. Add that amount, and that is the amount you should raise. Basically saying it should give you an 18-month runway without having to worry about cash. And you're seeing your negative cash flow, basically you're saying. So add your revenue, add your fundraise, and then you plug in your fundraise. Basically, that's what your cash flow and your vision for the next 18 months should dictate how much you raise in the early stage. And like somebody said, can I raise 5 crores early? Yes, you can. If you really believe that your business needs it and you have a case, you have a business plan, you can show it. Yes, you can raise a little higher also. So it should not be, hey, I want to raise 1 crore. Where did you get that 1 crore? Why do you need that 1 crore? That's why your business plan, cash flow should be very important for you to understand how much money you need to raise. Anything else?
Hi, do we have any more questions? So Sarita, to start off, I had a question on one of your slides. I think it was where you were explaining a particular startup, like a hardware startup in which you had invested, Blume Ventures had invested. There was something called as a KPI for entry, and I could see it was changing. Can you elaborate on what that was? Is that specific to the startup, or is that like a framework?
No. It's basically KPI is key performance index.
Yeah,
so
yeah.
For every startup, it will be different. Let me.
Is that something Blume comes up with, or?
No, it's kind of thumb rules.
Okay.
Let me take you through it.
Sure.
Yeah. So here, oh, not here. Sorry. Yeah.
Yeah, this slide.
So here, sorry. Yeah. So key performance index here, meaning there's some way for us to measure. Now in a B2C commerce, we can't, there's no revenue as such, right? So for a BFSI, again, SMB startup, sorry, I don't know. I think the screen sharing stopped suddenly.
Yeah, it's all right.
Okay, let me reshare it. Yeah, so here in case of B2C commerce, we look at transactions per month. So here you don't have revenue coming in. So we look at number of transactions or GMV, one of those, right? So each kind of, whether it's B2B, B2C startup, their KPIs are different. What we look as measurements or metrics, what we call metrics basically. In this case, in hardware startups, you can look at revenue. That's what we look at. In commerce, B2C commerce startups, we look at transactions per month or monthly active users, daily active users, GMV. What is the GMV if there's anything happening in that space? That's what we look at. And here we look at for BFSI, so B2B, where B2B SMB, where they're selling to small and medium business in the finance space, the startup is. In their case, we looked at revenue earlier was 0, but then we looked at ARR, which is 400 crores. So in these two cases, we were looking at revenue, here revenue, here ARR, and in the middle is the transactions per month. As long as that is growing, it shows that there's growth.
Got it. Thank you.
Like for example, in like your video apps, right? In the video apps, people don't care about your revenue. If you go to a Chingari and stuff, they look at 3-4 things. What are your monthly active users, daily active users, number of downloads? That's what is key
performance indicator for that. Yeah. Just opening up to the participants if you have any more questions. I know we did address a lot of questions as we were progressing in the session. Any more questions? Else I would like to wrap it up. So thank you, Sarita, for doing such an engaging session with our startups. I mean, taking us through the entire process from where you started and even giving an entire VC perspective on a startup. I'm sure all of us here have resonated with that last poem for sure, at least at some level. And I hope everyone, hello, sorry, is there somebody, the question?
Yeah, I have a question.
Yes.
Pradeep.
Yes.
Yeah. There's if it's a deep tech startup, and let us say we don't really have a product because our product needs mass manufacturing. What kind of other metrics can we look at? Let us assume we have a B2B traction. We have an MOU with a B2B company, and we are moving forward with a lot of traction, but there's no real sales. There's only trials, and then basically baseline testing that is happening with the company or with the product. How will a VC evaluate us? Because definitely we can't show users, we can't show sales volume, even though we are hardware, we are looking at a B2B supply. The B2B supply would be dependent on the OEM company. So how does this scenario play out with Blume?
Sure. Sure. So, Pradeep, I'll give you examples of hardware startups we have invested in. Grey Orange is one of our most successful. It's gone global. It's all over the world now, and they're US headquartered. They started as BITS students, third year or fourth year students when we actually funded them, and they've come a long way. You should read up their story. We've also invested in other hardware startups, Tartan Sense being one of them, which is a weed removal robot again. We've invested in Ethereal Oiler. So couple of things, I understand where you're coming from. How do we evaluate it? We do look at the market size. We are constantly reading, hearing what is the next big thing? What are the next things in demand? What problem are you solving? Are you solving in the factory space, in the industrial space? What space? We have experts who will advise us. So firstly, we'll see if you have IP, right? What is your IP? Do you have any patents? What is your differentiator? If we see that your product is differentiated, then we look at market size. If the market size is large enough, it should be significantly large, like I mentioned. Then we take your product or your thing to some industry experts to kind of triangulate whether there's really a need for this. And if so, then we look at the competitive space. Who are the other competitors? And if we feel that you have an edge over the rest, then we will get some experts also to evaluate. And if we are convinced that, yes, this is something very exciting, solving a real problem, and from India, manufacturing is not actually a very big challenge now anymore. If we can build in India and sell globally, great. If your business model is not exactly what we're looking for, we may even give you feedback that, hey, this business model may not work, but why don't you look at this? Maybe even evaluate doing 50-50. So that's exactly what we're doing with the startup that we evaluated yesterday, where he has two streams of revenue. One is he's selling the product and he's making revenue and with an AMC, right? Recurring. And the other is as a service. So you don't pay upfront for the product, you pay. And surprisingly, in India, factories are willing to pay for your product and buy it outright. But as you go global, people don't want CapEx. They're willing to pay monthly. So more as a service and using your product as a service and paying monthly. So I think broadly, if you ask me, as long as we see there is potential, we do a market study and we see that you have a differentiator and you have IP, that's good enough at your stage. If you've sold something, great. If you've not sold also, it's fine. The company we are evaluating has sold only 5 products so far, 5 pieces so far, and we are fine with it. If you're not sold also, it's fine. As long as you show that there are customers who are willing to buy your product.
Pradeep, I hope that's answered your question. Any more questions?
Can I ask an off-topic question?
Sure, Rishabh, tell me.
Ma'am, why do they sell their good going company like Benny Bessel sold the Flipkart to Walmart?
Yeah. Because eventually everybody wants exits, right? Tell me, how will the investors get an exit? So people, SoftBank, everybody is pumped in huge money. I think Flipkart, to get to $1 billion, typically you need to raise $100 to $200 million, right? Flipkart, I think, went above. They raised about $350 million, $400 million. How will the investors get an exit? Somebody has to buy out the company. Something has to happen, right? Otherwise, how will investors get exit? That's why you have to eventually sell out. because or you go IPO, you don't have to sell out. That's why we as VC funds are now pushing our startups to think IPO. Don't need to always think acquisition. Indian IPO laws are not very easy unless you're profitable, you show 3 years of profitability, XYZ. It's not easy to go IPO in India. It's very tough. If you're a delivery corp or something, it's much easier to go IPO. But having said that, IPO is a route where you don't have to sell out. If Sachin and Vinny had stayed on and they'd taken Flipkart IPO, I think that would have been great. They didn't have to sell out. But investors have to get exit one way or the other, right? They also have to share, like I told you, they have to give back the money to the LPs. It's not their own money, or they're not doing charity, so they have to return the money. Yeah.
So yeah, I think questions are almost done. In the interest of time, I will just wrap up. So thank you, Sarita, once again for doing the session for us. To the participants, I'll circulate the PPT as well as the video. So, oh, I'm sorry, Vivek has a question to ask. So we'll take that as the last one. Vivek, please go ahead and ask your question.
One sec. You just ask your question. I just need to get some light in.
Sure.
Sure.
Hello,
Vivek,
hi Vivek. You can unmute yourself and ask the question.
So you were giving an example that a company which manufactures the product in India and they make revenue by selling the product out, and also they make revenue by giving out the service from the software.
Yes.
So we were speaking with the investor, like we also have a same stream of business where we manufacture product and also we do a service using that product. Like we have a software where we can generate revenue out of software, and then we can also generate revenue out of selling the hardware.
Yeah.
So when we were presenting this to an investor, and he was saying that it's not good to have both hardware and then software in a single roof, because both are too extreme, and where you have to spend both for your manufacturing and also you have to spend for your software team and everything. So how do we have to see this? Like it's good to bring this hardware and then software under a single roof, or how can we see this?
No, like if you see our company Grey Orange, right? Grey Orange is a robot basically in the logistics space. And they are giving, now they are actually converted to a SaaS model, robot as a service. And I mean, yes, they do. They are making the hardware also and working on the software. So I don't think that's an issue. As long as you show that it's a full package that you're servicing and your clients are willing to pay for it, I think it's fine. I don't think, I mean, how do you, otherwise hardware, just selling hardware is not so attractive to the VCs. In fact, if you can show it as a package, it helps, because then you kind of broaden your, even your verticals and industries you can target can be better if you have a software solution. You can pivot, you can customize it a bit for different industries. So no, I don't know who's, I don't know who's advised you this, but we've seen, we have in our own portfolio companies which are successful doing this.
Okay.
Yeah. Okay.
Vivek, I hope that's answered your question. So
Yes.
once again, I will lastly wrap this up. If there are any more questions, I'll reach out to you, Sarita, and I'll also share the PPT with the participants. So thank you so much for the session, and thank you for your time. Thank you, participants.
Thanks, Priya. Always a pleasure, and feel free to.
Thank you, ma'am.
Thanks. Bye.
Bye.
Bye.